Alright, so we're going to finish up chapter 3 by doing common size analysis. So basically what you're doing is you're going to take some of these metrics, or all of these metrics for each one of these sheets, and divide it by a common thing. So in this instance, we're going to divide each one of these metrics: cash, ST inventory, AR inventory, total current assets, net fixed assets. We're going to divide that against that total asset number. And that way we can see, hey, what's driving our increase or decline on each one of these sheets as we go through the different slides. And then we can say also, hey, what's really different versus the industry average? So once we see there, we use our ratios to determine if we have a issue or not. But then once we decide that, hey, we have something we want to dig into, this is a great way to really quickly see what's off versus the industry average. And I won't go through each one of these, but you can easily see how we're comparing each of these. Same thing here, we're just looking at all these and we are dividing them by total liability and equity. Our notes payable, we can see that it's way above the industry average, and we've stated that multiple times throughout the chapter that that's where this company needs to improve. Long-term debt is actually in a better spot versus, so maybe they need to shift some of those notes payable into a long-term debt vehicle to get some better interest rates, to help them out a bit. But that's how you would do this. And again, you can also compare year over year, right? What's improving, what's declining versus within the company versus across the industry. Bit of a broken record, but that's what these ratios and different types of analysis are used for. So here on the income statement, we're going to divide versus our sales. We're going to see our COGS as a percentage of sales. That's a big one. You want to make sure that your cost of goods are definitely not above industry average if you can help it. And here you can see they're doing well with that. I'm trying to think if anything else just stood out, but that's really the big one that I would look for. Depreciation, that's not a huge one as far as the total overall, but it's definitely below industry average. All right. So here we're looking at, again, this one is looking over change from 2015. So they'll typically call this a 3-year CAGR. So you're going to be, comparing 2017 to the first year, 2015. So we can see in 16, obviously, we were down from 15 in multiple areas. But then in 17, as the estimates, you can see they are showing growth. So from year to year, you have one-time events that may impact stuff that's not going to happen on a reoccurring basis. And that's where this kind of analysis is very important. As you think about building out a 5-year strategy for a company, you would use this type of analysis to say, hey, over the last 3, 4, 5 years, here's been our growth rate. Here's how much we've changed in comparison to year one, whatever year one you decide is. And that gives you a good indication of where the company is going long term versus just looking at 1 year. There's a lot of noise that could be in there. This eliminates that noise. So we can see over a longer period of time, they're obviously growing on sales. Their COGS are growing at a lower rate, which is fantastic. Right, so all that is good stuff. Their net income has grown dramatically from 2015. If 2017 plays out how they have forecasted, 188% compared to 2015. So how did their assets change? Right, they went up to 140%. Right, or 139.4, not quite rounding up to 140. Again, I'm not going to belabor this one. It's the same type of analysis, but for each one of these things we're looking at, we can do the same type of thing. Liabilities and equity, 139, right? Very similar. All right, so we can see that our total assets are projected to grow 139%, while sales are projected to grow at 105%. So again, their asset utilization remains a problem. We've seen it throughout. That's that inventory turnover, all that good stuff. So the ratios will play out everything you see in the numbers, and that's the good thing. It always is the numbers don't lie. They're gonna be backed up by the ratios. All right, so quickly we're going to go through the DuPont equation. It focuses on expense control, asset utilization, and debt utilization. It shows how these factors combine to determine the return on equity. So again, not going to walk through each one of these. You guys can read this. Profit margin, total asset turnover, equity multiplier. Down below we put the formulas for you so we don't do a searching for those. So this will be a good page to have handy if you have to figure out the DuPont equation. All right, so again, we're looking at this year over year. How is this changing year over year? This is a great chart. You can see each one of the different metrics involved and how they're changing. And then you can compare that to the industry average. All right, so potential problems when we're thinking about ratio analysis. And I think we've talked about this a little bit before, but I'll go a little deeper. Comparison with industry average is difficult because not two companies are obviously not the same. They have different divisions, different product lines. Even though they may be in the same industry, they are going to have differences that are going to change, these ratios. So we definitely need to be aware of that as we compare company to company, even within the same industry. Seasonal factors can distort ratios. Again, that's why I like to look, even when looking at industry average, I love to look at multiple years to see, hey, was this a one-year thing? I used to work for an amusement park company, and if you had bad weather during the key part of the season, it could really impact your numbers for that year. So that's the type of noise that I want to take out. I would want to look at all amusement parks in September of 2052, whatever, right? And see, hey, did the other theme parks have this issue? So it's not a company problem. It was just a one-time event. That you can make statements and ratios look better than they are. There's some window dressing techniques. People shift money in between buckets, so that's definitely something to look out for. And then different accounting and operating practices can also change the comparisons. There are also greater risk if revenues are tied to a single customer or a single product. Right? It's a big risk. If the only person you're selling to is Walmart and they decide to sell the same item from a different supplier, you're out of business. Right? So you need to make sure, just like an investment, you would want to diversify your customers that you're selling to and do your best to diversify your product lineup. That's why you see these large companies merge and join forces, even though they may seem like competitors. They are, diversifying their product offerings to reduce risk. While frozen foods may be on the uptick, canned food is on the downtick, right? So like a Campbell's soup is struggling. That's where a frozen food company is having a good year. So that's an example of needing to diversify your portfolio. Again, reliance on a single supplier. If you're buying all your raw goods from one supplier, there's risk there. And then if you have a high percentage of your business that's generated overseas, that is seen as a risk with global factors that are out there, macroeconomic stuff, tax implications. It does create additional risk. And then you also need to think about what's the competitive situation, what products are in the pipeline, and what are the legal and regulatory issues. These are all factors that we think about. So as we go through all these ratios and all these formulas and being able to compare and contrast within the company, outside of the company, these are the things that we also need to think about. These are qualitative factors. They're not numbers. This is not something we can put a number to. But as we look at a company, look at our own company, look at other companies, we really need to take all this into account to make our final decision to give really good, sound financial guidance on what we should be doing. So as financial managers, that's what we're doing. So this is a great slide of how to sort of all tie it all together, but then also use these qualitative factors and not just rely on the numbers, because there may be stuff outside of the numbers that really either backs them up or contradicts what's going on in the numbers. Hope this was helpful. Have a great rest of the week, and we'll talk to you soon.